Alright, let's count down 5 AI companies that could seriously challenge Nvidia's throne. Think of these contenders as hidden gems in the AI gold rush that most investors are overlooking. At number 5, we have a pure-play AI software company with impressive quarterly growth. At number 4, a company whose unique licensing model allows it to profit from virtually every AI device without manufacturing a single chip themselves. But the top 3 contenders? These companies have the scale, technology, and strategic partnerships to potentially shake up the entire industry. Their growth trajectories might surprise even the most dedicated Nvidia bulls. Let's break down why these 5 companies deserve a spot on your AI watch list right now. The Nvidia reality check. Why looking beyond the leader makes sense. So, Nvidia is basically the prom king of AI stocks right now. But here's why that crown might be getting a bit heavy. When we talk about AI investing, Nvidia might as well have its face printed on the money. With a staggering 92% market share in data center GPUs, they've become the default option for anyone wanting to jump into the AI gold rush. It's like when everyone had to have Apple stock during the smartphone boom. Nvidia has become that must-have investment that your uncle, your hairdresser, and even your gym buddy keep bringing up at every opportunity. But here's the thing, when everyone's at the same party, the punch bowl eventually runs dry. Nvidia's stock recently took a 23% nosedive from its peak, giving investors a not-so-gentle reminder that even market darlings can have bad hair days. We're talking about hundreds of billions in market value vanishing faster than your motivation at the gym in February. This sudden drop highlights something super important that many investors forget when they're caught up in the hype. Relying on just one company, even a powerhouse like Nvidia, is like putting all your eggs in a basket balanced by a squirrel that just discovered espresso. The risk is very real, even when the company seems unstoppable. Let's talk valuations. Nvidia has been trading at price-to-earnings ratios that would make even the most optimistic tech investors do a double take. These stretched valuations mean all that future growth everyone's expecting is already baked into the stock price. Nvidia doesn't just need to succeed. It needs to absolutely dominate in ways that exceed what investors have already paid for. The market's expectations have reached superhero levels, making it nearly impossible for Nvidia to deliver the kind of growth that justifies its astronomical price tag. There's also this whole supply chain situation that even Nvidia can't completely control. Their cutting-edge H100 chips, the ones powering all those ChatGPT conversations, face serious manufacturing constraints. The upcoming Blackwell chips have the same potential bottleneck issues. When you're dealing with components so complex that only a handful of manufacturers worldwide can produce them, you're bound to hit roadblocks that can limit growth and leave openings for competitors. These supply constraints aren't just annoying production problems, they're potential growth limiters. If Nvidia can't make enough chips to meet demand, that leaves the door wide open for hungry competitors to slip in and grab market share, while Nvidia's busy trying to scale up production. In the tech world, being supply constrained at the wrong moment can change market dynamics permanently. The tech world's history is littered with unbeatable companies that eventually stumbled. Remember when Nokia controlled 50% of the smartphone market before Apple and Android emerged? Or when Yahoo dominated search before Google came along? How about when MySpace was the undisputed social media king before Facebook took over? These former tech giants all seemed invincible until they weren't, a pattern that repeats itself with almost predictable regularity in the technology sector. Now, let's chat about concentration risk. Having too much of your portfolio in one stock is basically betting your entire life savings on a single number at the roulette table, even if it's a really good number, even if that number has been winning a lot lately. The math of diversification isn't sexy, but it works. Spreading your investments across multiple companies means you don't face financial disaster if one hits a rough patch. And speaking of rough patches, the AI landscape is like a toddler. It's still learning to walk and changing every day. The technologies, business models, and even the basic understanding of what AI can and can't do are evolving at warp speed. Assuming today's leader will definitely be tomorrow's winner ignores pretty much all of tech history. The AI ecosystem is way bigger and more complex than just the chips that power it. There's infrastructure, software platforms, specialized applications, consulting services, and tons of other pieces that make the whole AI revolution possible. Nvidia might be crushing it in chips, But that's just one piece of a much larger puzzle. And there are plenty of areas where Nvidia isn't even playing the game. This is exactly why looking beyond Nvidia means finding growth opportunities that might actually deliver better returns. When everyone's fighting over the same popular stock, they often overlook amazing companies that are attacking different parts of the AI value chain. Sometimes the best opportunities aren't in directly competing with the market leader, but in finding companies that are dominating their own specific corner of the market. Diversifying beyond Nvidia lets you capture growth in areas where competition isn't as fierce and valuations aren't as stretched. It's like showing up to a restaurant where there isn't a 2-hour wait. You might actually get a better meal without fighting the crowd that's lined up at the trendy spot next door. The other thing to remember is that different parts of the AI ecosystem will grow at different rates. While the chip battle gets all the media attention, infrastructure providers, software platforms, and specialized AI applications might actually grow faster in the coming years as AI moves from experimental to mainstream. By spreading your investments across different segments, you position yourself to benefit no matter which area ends up growing the fastest. Supermicro computer, the infrastructure powerhouse behind AI. When you see those massive AI data centers, someone's got to build the actual hardware that houses all those fancy Nvidia chips. While everyone's obsessing over those shiny AI chips, they're completely missing where the real money's being made, in the massive infrastructure needed to keep those chips running. Supermicro computer has quietly doubled its revenue to nearly $15 billion last year, while planning to hit $40 billion by 2026, all by solving the not-so-sexy problems of how to actually house and cool all this AI hardware. Let's be real, when we think about AI, we picture these magical chips doing all the work. But those chips are basically expensive paperweights without the specialized systems to house, power, and most importantly, cool them. That's where Supermicro computer comes in. They're the company building the actual infrastructure that makes AI possible in the real world. So what exactly does Supermicro do? They're basically the experts at creating high-performance computing solutions that physically house and optimize AI chips. Think of them as the apartment builders for those expensive AI roommates. They create cutting-edge environments that actually make those chips perform better. I recently heard about a major tech company that learned this lesson the hard way. They invested millions in top-of-the-line AI chips, set them up with standard cooling, and watched in horror as their system kept overheating and shutting down. Their fancy AI project turned into an expensive space heater. They eventually had to rebuild their entire data center with proper cooling infrastructure. Exactly the kind of problem Supermicro solves. You might be wondering, isn't SMCI just riding Nvidia's coattails? That's a fair question. After all, if they're just building fancy boxes for Nvidia chips, wouldn't they be totally dependent on Nvidia's success? The answer is both yes and no. While they definitely benefit from the AI boom Nvidia is driving, they've developed their own serious competitive advantages. The most impressive is their direct liquid cooling technology, or DLC for short. Those AI chips run hot, like really hot. Traditional air cooling is like trying to cool down your kitchen by opening the freezer door. It works a little, but it's super inefficient. Supermicro's liquid cooling is more like submerging your phone in ice water, except safe for electronics. It absorbs heat 1,000 times more efficiently than air. This means they can pack chips closer together, use less energy, and keep performance steady even under heavy loads. Over 30% of new data centers are expected to adopt this technology in the next 12 months, putting Supermicro at the front of this industry shift. What's truly impressive is Supermicro's financial performance despite past troubles. After overcoming serious accounting issues that nearly got them delisted from Nasdaq, they've completely turned things around. When they regained compliance, their stock jumped over 20% in a single day. The numbers speak for themselves. Supermicro reported nearly $15 billion in revenue for fiscal 2024, double what they made the previous year. And they're not slowing down. Their projection for fiscal 2025 is between $23.50 and $25 billion, aiming to hit $40 billion by fiscal 2026. That's growth that makes even jaded investors take notice. What's driving this explosion? Simply put, AI needs a place to live. As companies build AI capabilities, they need infrastructure to support it. Supermicro. positions itself as the premier US-based data center infrastructure solution provider. They want to be the go-to company when anyone needs to build systems for AI. Their relationship with Nvidia is fascinating. They're complementary. Supermicro builds systems optimized for Nvidia's GPUs, helping those chips reach their full potential. At the same time, they're potentially competitive, developing their own systems that could eventually compete with parts of Nvidia's offerings. They're both partners and rivals simultaneously. Supermicro offers a completely different kind of AI exposure than Nvidia. While Nvidia makes the chips, Supermicro makes everything else needed to run those chips at scale. This means they could continue growing even if chip margins decline. If AI chip prices fall, which many experts expect, more companies will build AI infrastructure, benefiting Supermicro. Think of it like the gold rush. Nvidia sells the pickaxes, but Supermicro sells the infrastructure, the mines, transportation, housing, and logistics. Sometimes the infrastructure providers make more money than the tool providers. What makes this even more compelling is that Supermicro isn't just focused on Nvidia. They've established relationships with other major chip providers like AMD too. This means they're not betting everything on one chip company winning. They're positioning themselves to benefit regardless of which chip designer comes out on top. Their focus on high-performance computing solutions that optimize AI chip performance means they're truly adding value, not just assembling components. They're solving real engineering problems, cramming more computing power into smaller spaces, cooling systems more efficiently, and reducing AI's massive energy consumption. As AI moves from experimental to mainstream, the demand for this infrastructure will only grow. Companies aren't just playing around with AI anymore. They're building it into their core operations, which means they need reliable, efficient infrastructure to run it. Supermicro is perfectly positioned to meet this growing demand. AMD, the direct competitor coming for Nvidia's lunch. While everyone's focused on Nvidia, another chip giant has been making some serious moves that most investors are completely missing. What if I told you the second largest GPU maker in the world has been secretly building AI chips with nearly 3 times the memory capacity of some Nvidia models? And that major cloud providers like Microsoft and Google are already shifting billions in spending their way? I'm talking about Advanced Micro Devices, or AMD, which has positioned itself as the most direct challenger to Nvidia's AI chip throne. Now I get it, when you hear AMD versus Nvidia, you might think, come on, isn't this like comparing a Honda to a Ferrari? But that perception is exactly what makes AMD such an interesting opportunity right now. Let's talk about AMD's newest weapon in the AI chip wars, the MI325X accelerator. This beast comes packed with a whopping 288 gigabytes of memory capacity, which towers over what Nvidia offers in comparable models. Think of it like swapping out a family sedan's engine with a Formula One power plant. Suddenly you've got way more horsepower to handle the most demanding AI workloads. As these models grow increasingly complex and data-hungry, this memory advantage becomes absolutely critical. Trying to run advanced AI on insufficient memory is basically impossible, like trying to pour the ocean into a bathtub. The impressive part? AMD's MI300X accelerator is actually performing on par with, or even better than Nvidia's H100 in certain AI inference tasks. That's the underdog boxer landing unexpected punches on the heavyweight champion. What's making waves in Silicon Valley is AMD's strategic partnership game. They've locked in deals with Microsoft Azure and Google Cloud, 2 cloud computing behemoths. These tech giants aren't making these partnerships for fun. They're actively trying to reduce their dependence on a single supplier, Nvidia, which currently leaves them with zero negotiating power on price. It's the tech equivalent of the cool kids suddenly inviting the smart, quiet kid to their lunch table because they realized how brilliant they actually are. Hardware superiority only gets you halfway in the AI world, though. The software making those chips functional is equally crucial, and AMD has dramatically improved in this department. Their ROCm software stack, essentially the operating system for their AI chips, has seen massive performance gains recently, doubling the performance of their MI300X accelerator across popular AI models. It's like finding out your car can suddenly go twice as fast with just a software update. You might wonder, if AMD is so great, why isn't their stock price rocketing like Nvidia's? This is precisely where the opportunity gets interesting. AMD's current valuation metrics show a much more attractive investment compared to Nvidia, with significantly lower price-to-earnings and price-to-sales ratios. In everyday terms, you're paying way less for each dollar of AMD's earnings and sales than you are for Nvidia's, like finding the exact same premium product at a massive discount at another store. AMD also benefits from their diversified business model. Unlike Nvidia's heavy reliance on their GPU business, AMD competes across multiple fronts: CPUs, GPUs, and AI accelerators. This creates several revenue streams instead of just one, similar to having multiple jobs rather than depending on a single paycheck. If one sector hits turbulence, the others help carry the weight. Consider this perspective. Nvidia has essentially gone all in on AI chips. That's fantastic during boom times, but what happens during a temporary slowdown or supply chain issues? AMD can lean on their robust CPU business, which continues stealing market share from Intel, or their gaming GPU division competing with Nvidia's GeForce products. AMD isn't going to dethrone Nvidia overnight. Nvidia maintains a substantial advantage in AI software development tools like CUDA, which many developers already know and use comfortably, similar to how everyone defaults to Microsoft Word despite alternatives existing. But AMD is steadily closing this gap. Their ROCm software stack improves with each update, and the performance gains are substantial. As developers grow more comfortable with AMD's tools, the switching costs for companies wanting to diversify away from Nvidia continue dropping. The situation reminds me of the CPU market transformation several years ago. Remember when Intel completely dominated and AMD was barely considered? Look at the CPU landscape now. AMD has not just caught up, but sometimes surpassed Intel in performance. History might not repeat exactly, but patterns often emerge. What makes AMD particularly compelling is that they don't need to completely overtake Nvidia to be a successful investment. The AI chip market is expanding so rapidly that even capturing a larger market share would mean tremendous growth for AMD. They're not just competing with Nvidia. They're offering the supply chain diversification that major tech companies increasingly view as essential, creating a significant runway for growth even as a strong number 2 player in this booming market. ARM Holdings, the architecture behind every AI device. Speaking of diversification, what if you could invest in a company that collects royalties from nearly every major tech player in the AI game instead of betting on just one? While companies scramble to find alternatives to Nvidia, there's a stealth player that's been hiding in plain sight, powering the devices in your pocket, on your wrist, and soon, virtually every AI system on the planet. This is ARM Holdings, and they've pulled off something genuinely brilliant. Instead of competing in the crowded chip manufacturing space, they've positioned themselves as the architects behind the entire mobile revolution. They're essentially the blueprint creators of modern connectivity, designing the fundamental language that powers our digital world. Here's what makes ARM truly fascinating. They don't actually make any chips themselves. They design the core architectures and instruction sets that power most of the world's mobile devices, and then license these designs to companies like Apple, Qualcomm, Samsung, and MediaTek. These companies either use ARM's designs directly or create custom versions based on ARM's instruction set. Imagine ARM as the creator of a universal language that virtually all mobile computing speaks. And now that same language is becoming essential for AI. Many investors overlook ARM because their business model differs from traditional chip manufacturers. There are no massive factories or supply chain complications, just intellectual property and licensing deals. But this simplicity is precisely what makes them such a compelling investment opportunity. ARM's reach is staggering. Their technology powers approximately 280 billion chips shipped worldwide. That's over 35 devices for every single person on Earth, creating an unparalleled foundation throughout the tech ecosystem. The real power of ARM's model lies in how beautifully it scales. When chip manufacturers produce hardware, each new chip demands new materials, energy, factory time, and carries inventory risk. When ARM licenses a design, they can distribute it thousands of times with virtually zero additional cost. It's the ultimate high-margin tech business: create once, sell repeatedly. Their business operates through 2 main licensing tracks. First, there's processor IP licensing, where companies like MediaTek license specific ARM core designs to integrate directly into their chipsets. Then there's architecture licensing, which allows tech giants like Apple and Qualcomm to design custom cores based on ARM's instruction set. This flexibility has helped ARM become the foundation for virtually the entire mobile ecosystem. For investors, this creates an extraordinary opportunity. ARM recently announced what might be the most profitable price increase in tech history. They're raising licensing fees by up to 300% for their newest designs. This price hike transforms into pure profit flowing straight to the bottom line since their costs remain relatively stable. This strategic initiative, internally codenamed Picasso, aims to boost their smartphone-related annual revenue by roughly $1 billion over the next decade. When your designs constitute essential infrastructure for an entire industry, you possess pricing power that most businesses can only dream about. Now let's talk about why ARM is positioned to be a major AI winner. The same efficiency that made ARM perfect for mobile devices is becoming critical for AI applications. As AI moves from massive data centers to everyday devices, what techies call edge AI, ARM's architecture serves as the natural foundation. Their latest chip designs are specifically optimized for AI workloads, enhancing both performance and energy efficiency, crucial factors as AI capabilities expand beyond cloud data centers into smartphones, cars, and everyday devices. We're moving toward a world where AI processing happens everywhere, not just in massive server farms, and ARM is perfectly positioned for this shift. In their most recent fiscal year, ARM reported revenue of $3.23 billion with profit margins around 10.1%. As their price increases roll through their contracts and AI adoption accelerates, both revenue and margins have significant room to grow. The beauty of ARM's model is that they win regardless of which specific chip manufacturers dominate the AI race. Whether it's Qualcomm's next mobile processor, Apple's latest custom silicon, or Samsung's newest flagship chip, they all pay royalties to ARM. It's like owning a toll bridge that every AI company has to cross. Think about it this way. Investing in Nvidia means betting that Nvidia specifically will continue dominating the AI chip market. Investing in AMD means betting that AMD will successfully challenge Nvidia. But investing in ARM means betting on the entire ecosystem expanding, regardless of which individual players win or lose. For investors, this creates a uniquely attractive risk profile. You get exposure to the AI revolution without having to correctly predict which specific manufacturer will lead the pack. As AI capabilities become standard in more devices, ARM collects more royalties, regardless of which company's name is on the chip. And unlike chipmakers who need to continuously invest billions in new manufacturing facilities and cutting-edge processes, ARM's intellectual property business requires relatively modest capital expenditures. They invest in R&D to stay ahead technologically, but they don't need to build and maintain massive factories. This capital-light business model means ARM can return more cash to shareholders through dividends and buybacks as the AI boom accelerates. For investors seeking both growth potential and income, this creates an attractive combination that pure chip manufacturers often can't match. One last thing that makes ARM particularly interesting: they're positioned at the intersection of two massive computing trends, mobile and AI. As these worlds increasingly overlap, with AI becoming essential to mobile experiences and mobile devices, Palantir, the AI-powered problem solver. At the intersection where AI meets real-world problems too complicated for humans to solve alone stands a company that's neither a chipmaker nor a cloud giant. While everyone's been obsessing over processors and server racks, Palantir Technologies has been quietly building something potentially more valuable: the intelligence layer that makes sense of our messy, complicated world. When an organization faces a data problem so massive that traditional solutions fail, they often turn to Palantir. The company's name might sound like something from Lord of the Rings, because it actually is. But their business is very real, using AI to solve complex problems that governments and Fortune 500 companies are willing to pay hundreds of millions to address. Many perceive Palantir as a shadowy government contractor, which isn't entirely wrong. They began by working with intelligence agencies and military organizations. However, viewing them as merely a government vendor misses their strategic positioning in the AI revolution. Let's break down what makes Palantir different. Their platforms, Gotham and Foundry, serve as comprehensive systems that integrate massive, messy datasets and apply AI to extract actionable insights. They function as the connective tissue between raw information and decisions that matter in the real world. A standout example is their Army Vantage platform contract renewal worth $401 million, potentially reaching $619 million. This platform enables military leaders to analyze data that enhances decision-making for personnel readiness and operational efficiency. When national security hangs in the balance, organizations choose partners who deliver results in high-stakes environments. Take their work with BP as another case study. Palantir helped BP integrate data from thousands of oil wells, reducing engineering time significantly and saving millions in operating costs. By connecting previously siloed information, engineers could quickly identify and solve production issues across their global operations, transforming how the entire organization made decisions about their critical infrastructure. What's particularly interesting about Palantir right now is their expansion beyond government work. While many investors still view them primarily as a defense contractor, their commercial revenue is growing faster than their government business. Commercial contracts now account for over half of their new deals, signaling a strategic pivot that's opening entirely new growth avenues. The numbers tell the story. In 2024, Palantir reported revenue of $2.87 billion, a 29% jump from the previous year. Their fourth quarter alone generated $828 million, representing 36% year-over-year growth. That's the kind of acceleration that makes investors pay attention. This growth comes largely from their AIP, artificial intelligence platform, designed to help enterprises implement AI solutions without requiring an army of data scientists. In a business landscape where organizations want AI but lack the technical expertise to implement it effectively, Palantir serves as the guide that bridges that gap between ambitious AI goals and practical implementation. Their business model creates incredible resilience through deep client integration. Unlike software companies that ship a product and move on, Palantir embeds teams within client organizations. This high-touch approach creates deep integration that becomes extremely difficult to replace. Imagine you're a corporation that spent years working with Palantir to build systems now essential to your operations. Their teams understand your business, your data is structured in their systems, and your workflows depend on their tools. Switching to a competitor becomes potentially disastrous. This creates the customer stickiness that software companies dream about. This embedded approach leads to enormous contract values, often exceeding hundreds of millions of dollars, because Palantir sells mission-critical capabilities that transform how organizations operate. The retention rates speak for themselves. When clients invest in Palantir's solutions, they tend to stay. This happens because the solutions deliver value justifying their cost. For enterprises facing complex data challenges, Palantir offers tailored solutions that generic AI tools can't match. Looking forward, Wall Street projects Palantir's growth to continue, with estimates suggesting a 32% increase for 2025. This optimism stems from their expanding commercial footprint and increasing demand for AI-driven analytics across industries. What makes Palantir particularly interesting as an AI investment is their focus on the application layer rather than infrastructure. While companies like Nvidia and AMD battle over chip performance and Supermicro computer builds physical systems, Palantir focuses on solving actual problems with AI. This positions them to potentially capture more value as AI becomes mainstream. Businesses don't buy AI infrastructure for fancy hardware. They buy it for solutions to real problems. Palantir starts with those problems and works backward to the technology. As AI chips eventually become more commoditized, as all technology does, the companies owning the intelligence layer and customer relationships may maintain their margins better than hardware providers. Palantir's deep integration with critical operations puts them in precisely that position. Palantir isn't without risks. Their high-touch model can be difficult to scale, and they face competition from both established tech giants and startups. Their valuation assumes continued strong growth, meaning stumbles could lead to significant stock volatility. But for investors looking beyond obvious AI plays, Palantir represents something different, a bet on AI's problem-solving capabilities rather than just computing power. In a market obsessed with chips and infrastructure, focusing on the intelligence layer might be the contrarian play that pays off. C3.ai, the pure-play enterprise AI software bet. If Palantir is the contrarian play in AI problem-solving, then C3.ai might just be the Vegas-style all-in bet on enterprise AI adoption. While most tech companies dabble in artificial intelligence, C3.ai went so bold they literally put it in their name and ticker symbol. When a company chooses AI as their stock ticker, you've got to wonder, are they genuinely pioneering the field or just riding the hype train to attract investor dollars? The reality is more nuanced than it first appears. C3.ai isn't some overnight sensation trying to cash in on AI fever. They've been focused exclusively on enterprise AI solutions since before most businesses even understood what artificial intelligence could do for them. Unlike broader tech giants who offer AI as one of many services, C3.ai is hyper-specialized in creating pre-built AI applications for specific industries. This specialization matters tremendously. Instead of forcing manufacturing companies, oil and gas operators, or financial institutions to build AI solutions from scratch, C3.ai offers them ready-to-implement applications designed specifically for their industry challenges. What does this look like in practice? Take their predictive maintenance application for manufacturing. It analyzes equipment sensor data to predict failures before they happen, saving companies millions in downtime. One energy company reduced equipment failures by 40% after implementing C3.ai's solution, translating to real operational improvements. This focused approach is showing promising signs in their financials. Their most recent quarterly sales jumped 26% to reach $98.8 million. Not massive compared to tech giants, but significant for a company betting its entire future on enterprise AI adoption. What's particularly interesting is how C3.ai is evolving its business model to accelerate growth. They've recently shifted from a subscription-based pricing model to consumption-based pricing, which aligns perfectly with how modern businesses want to adopt new technologies. As CEO Thomas Siebel explained, this change means companies can avoid being locked into long-term contracts, essentially lowering the barrier to entry for new customers who want to test the AI waters. Think about it from a business perspective. Would you rather commit to a multi-year contract for technology you're not sure will deliver value, or pay based on what you actually use? This consumption model creates a lower risk proposition for potential customers, potentially accelerating C3.ai's customer acquisition and revenue growth as businesses dip their toes in the AI pool before diving fully in. C3.ai has secured impressive partnerships with the cloud computing trifecta, Microsoft, Google, and AWS. These relationships provide C3.ai with credibility and powerful distribution channels to reach enterprise customers. When your software solutions are integrated with the cloud platforms that businesses already use, you've eliminated another major adoption barrier. The market seems particularly excited about C3.ai's generative AI offerings. In just one quarter, they received nearly 50,000 inquiries from 3,000 different businesses, a staggering indication of market interest. This surge of attention suggests that C3.ai's specialized approach is resonating with businesses looking to implement practical AI solutions without building entire data science teams. Looking ahead, analysts project C3.ai's revenue growth will accelerate to approximately 23% in fiscal year 2025. This growth trajectory is expected to be fueled by their industry-specific applications and the rapidly expanding demand for generative AI solutions across multiple sectors. However, let's not sugarcoat the risks here. C3.ai represents perhaps the highest risk, highest reward option among all the companies we've discussed. Unlike Palantir, which has deep government, relationships and consistent contract revenue, or hardware players with tangible products, C3.ai is betting everything on rapid enterprise AI adoption. The company isn't profitable yet, which makes it vulnerable in a market that's increasingly focused on fiscal discipline. Their premium valuation compared to other software companies raises questions about sustainability without a clear path to profitability. In the software world, investors eventually want to see black ink on the income statement, not just growth projections. Additionally, while C3.ai is focused on industry-specific applications, they're not alone in this approach. Larger tech companies with deeper pockets and existing enterprise relationships could decide to compete directly in this space, potentially squeezing C3.ai's growth potential. What makes C3.ai fascinating is that their success or failure will likely serve as a bellwether for enterprise AI adoption as a whole. If businesses across manufacturing, energy, financial services, and other traditional industries embrace AI solutions at the pace many analysts predict, C3.ai could be perfectly positioned at the intersection of supply and demand. On the other hand, if enterprise AI adoption moves more slowly than expected, perhaps due to implementation challenges, regulatory concerns, or simply organizational inertia, C3.ai could find itself with a perfect product for a market that isn't quite ready yet. For investors, the question becomes whether you believe in the timing of the enterprise AI revolution. The technology is impressive, but technology alone doesn't guarantee business success. The history of tech is littered with companies that had the right idea at the wrong time. C3.ai is focused on turning AI capabilities into practical applications that deliver measurable business value. It's the difference between selling someone a powerful engine versus selling them a car that gets them where they need to go. For investors with a higher risk tolerance, C3.ai represents an intriguing pure play bet on enterprise AI adoption. If you believe businesses across traditional industries will accelerate their AI implementations in the coming years, C3.ai offers perhaps the most direct exposure to that trend among publicly traded companies. Just remember that with higher potential rewards come higher risks. Unlike our other contenders who have diversified revenue streams or established market positions, C3.ai is all in on a specific vision of how and when enterprises will adopt AI technology. The competitive landscape, how these five stack up against Nvidia. David versus Goliath stories make great movies, but in the AI market, they make even better investment opportunities. When a company reaches a $3 trillion market cap like Nvidia, it's natural to wonder if the game is already over. But here's the fascinating reality. The companies growing fastest in the AI race aren't always the obvious market leaders. Let's stack our 5 challengers against the reigning champion and see who actually has a shot at dethroning Nvidia, or at least outperforming it as an investment. Let's start with the competitive landscape. Nvidia dominates with its $3 trillion market cap, while our challengers range from AMD at $300 billion down to tiny C3.ai at just $3 billion. Imagine Nvidia as a skyscraper, with AMD being a 10-story building, ARM a 5-story office at $150 billion, Palantir and Supermicro as modest houses at around $40 billion and $30 billion respectively, and C3.ai as a tiny cottage at just 0.1% of Nvidia's value. This size difference actually creates an interesting investment dynamic. Smaller companies can deliver explosive percentage growth that's mathematically impossible for a behemoth like Nvidia. Supermicro Computer exemplifies this growth potential with projections to reach $40 billion in revenue by 2026, a massive jump from their current position. AMD's data center segment is expected to grow 98% in 2024 alone, dramatically outpacing their overall company growth of 13%, showing where their future is headed. Palantir and C3.ai are posting strong 29% and 26% year-over-year growth respectively. While these absolute numbers might look tiny compared to Nvidia's massive revenue, the percentage growth tells a different story, one where these challengers are expanding their footprint rapidly. Profitability tells another important part of the story. AMD and ARM maintain healthy profit margins, giving them resources to fund ongoing innovation. ARM's licensing model is particularly impressive. They're increasing fees up to 300% for new designs without needing substantial new investments. Palantir has steadily improved their profitability, while Supermicro operates on thinner margins but compensates with volume and scale. C3.ai remains the financial question mark, still working toward consistent profitability as they scale their enterprise AI platform. Each challenger has built unique competitive moats that Nvidia can't easily replicate. AMD has positioned itself as the only serious alternative for high-performance computing chips, with major cloud providers actively choosing AMD to reduce their Nvidia dependence. These partnerships with Microsoft, Google Cloud, and others create a powerful cycle of validation and adoption. ARM Holdings controls the fundamental architecture powering billions of devices worldwide, creating an ecosystem that's nearly impossible to displace. Their licensing model allows them to profit regardless of which manufacturer ultimately dominates, They're selling pickaxes in the AI gold rush. Supermicro Computer's expertise in direct liquid cooling technology addresses one of AI computing's biggest challenges, managing intense heat from power-hungry chips. This specialized knowledge gives them a unique position within the infrastructure ecosystem, potentially allowing them to capture value even if chip margins decline. Palantir's deeply embedded software creates tremendous customer stickiness. Once implemented, their solutions are extremely difficult to replace. Their government relationships and security clearances create additional barriers that few competitors can match. C3.ai focuses on pre-built enterprise AI applications for specific industries, offering specialized solutions that generic platforms lack. Their shift to consumption-based pricing could accelerate adoption by lowering entry barriers for enterprises implementing AI. Valuation metrics reveal significant opportunities. Nvidia's PE ratio sits significantly higher than the S&P 500 average, with tremendous future growth already priced in. This contrasts with companies like AMD, which trades at much lower multiples despite similar growth potential in the AI space. This creates opportunities in companies growing twice as fast as Nvidia on a percentage basis, while trading at half the valuation multiples. The kind of math that makes professional investors salivate. So which challenger has the strongest case for outperforming Nvidia over the next 2 to 3 years? AMD emerges as perhaps the most compelling based on growth trajectory, current valuation, and competitive positioning. Their direct competition with Nvidia in high-performance computing, combined with reasonable valuation and diversified business model, gives them multiple paths to success. Supermicro Computer offers tremendous near-term growth potential, with revenue projected to nearly triple within a few years. Their position as an infrastructure provider rather than chip designer provides some insulation from the chip wars. ARM Holdings presents a defensive play with recurring revenue across the entire AI ecosystem. They profit regardless of which chip maker dominates, similar to how they benefited from the smartphone revolution regardless of whether Apple or Samsung sold more phones. C3.ai represents the highest risk, highest reward option for pure-play enterprise AI exposure. Their success depends entirely on enterprise AI application adoption, but accelerated adoption could multiply their valuation several times over from current levels. Palantir occupies an interesting middle ground. Their established government business provides stability, while their commercial expansion offers growth potential. Their AI-powered analytics solutions address real-world problems for organizations willing to pay premium prices, giving them pricing power that many tech companies lack. Risk factors. What could go wrong with these Nvidia alternatives? With all these promising alternatives to Nvidia, it feels like we've just uncovered 5 hidden treasure maps, right? But let's get real for a second. What happens if these supposed Nvidia killers turn out to be more like Yahoo trying to compete with Google? The tech graveyard is littered with next big things that never quite made it. And when we're talking about investing your hard-earned cash, we need to be honest about what could go seriously wrong with each of these companies. Look, higher potential rewards almost always come with bigger risks. That's especially true when you're betting against a dominant market leader, crushing it in both innovation and execution. The elephant in the room is pretty simple. Nvidia's dominance could become more entrenched over time. History suggests that tech kings often stay kings longer than skeptics expect. Supermicro Computer faces significant governance risks that investors shouldn't ignore. Their auditor Ernst & Young literally quit over material weaknesses in internal controls. That's like your doctor refusing to treat you anymore. While they've filed delayed reports and met NASDAQ compliance requirements, these accounting issues could resurface. Remember Enron? Financial reporting problems often signal deeper issues. Plus, Supermicro's success depends heavily on Nvidia's ecosystem. They build systems around Nvidia's GPUs, making them vulnerable if Nvidia stumbles or relationships sour. Their rapid growth trajectory could hit a wall if ongoing litigation and reputational damage from past accounting issues return to haunt them. AMD's challenges stem from their perpetual underdog status. Despite impressive advances with their MI325X accelerator, they've historically struggled to gain meaningful AI chip market share. Their R&D budget remains dramatically smaller than Nvidia's war chest, limiting their innovation potential. Remember the AMD versus Intel CPU battles? AMD would gain ground only to fall behind in the next cycle. The semiconductor industry's cyclical nature leads to wild swings in performance and market share. Today's gains can quickly evaporate tomorrow. Betting on AMD requires believing they can finally break this pattern of coming close, but never quite overtaking the leader. ARM Holdings' licensing model creates unique vulnerabilities. Their reported plans to hike chip design license fees by up to 300% might boost short-term revenue, but could backfire catastrophically by pushing away major customers who have the capability and resources to design chips independently. Despite generating $3.23 billion in revenue for fiscal 2024, their modest $577 million profit margin raises questions about justifying their lofty valuation. Their high valuation leaves little room for execution missteps or growth disappointments, especially if customers balk at those dramatic price increases. Palantir Technologies' heavy dependence on government contracts creates dangerous concentration risk. If defense priorities shift, as they often do with administration changes, their revenue could drop dramatically. Their stock has already shown volatility due to concerns about potential defense budget cuts. Their business model requires deep client integration, limiting how quickly they can expand beyond government agencies. This high-touch approach might be great for customer retention, but it severely constrains how fast they can grow, especially as competition intensifies from both established tech giants and specialized AI startups offering more flexible solutions. C3.ai might have the market's coolest ticker symbol, but they're navigating the most crowded competitive landscape. They're battling tech giants with enormous resources while still searching for consistent profitability. Their recent shift to consumption-based pricing introduces unpredictable revenue streams, making financial forecasting more difficult, something Wall Street typically doesn't love. Even C3.ai's own CEO has warned about a potential AI bubble, noting that when there are technological breakthroughs, the market tends to overvalue them. When a company's own leadership expresses caution about sector valuations, investors should definitely pay attention. The broader risk for all these companies is that we might be witnessing another tech bubble forming in the AI space. The pattern feels eerily familiar. Exciting technology, sky-high valuations, promises of industry transformation, and investors piling in with FOMO. History teaches us that when everyone's singing the same tune about a can't-miss investment opportunity, it's usually time to locate the emergency exits. Tech history provides sobering examples of once dominant companies that faded into irrelevance. Yahoo dominated search before Google. MySpace ruled social media before Facebook. BlackBerry controlled smartphones before Apple. These cautionary tales remind us that betting against established market leaders like Nvidia comes with significant historical precedent, suggesting it's a risky move. Building your AI investment strategy beyond the Nvidia monoculture. The history of tech dominance isn't just about winners and losers. It's about ecosystems where multiple companies can thrive simultaneously. Remember when everyone thought Apple was dead in the 90s while Microsoft ruled everything? Fast forward to today where the AI landscape could be following a similar pattern that smart investors are already positioning for. Instead of obsessing over who will be the next Nvidia or which company will dethrone the champion, what if we completely reframed how we think about AI investing? The real opportunity is building an AI portfolio that captures growth across the entire ecosystem. Let's be real, this is an orchestra where different companies play different instruments, creating beautiful music together. You wouldn't attend a symphony just to hear trumpets for 2 hours, right? Your investment portfolio deserves the same diversity and harmony. The AI market is expected to reach $117.50 billion by 2029, growing at a shocking 31.05% annually. That's an enormous pie with plenty of slices for multiple players across the AI stack. Think of the AI stack like your favorite layered cake. The bottom layer has chip manufacturers like Nvidia and AMD creating raw computing power. Next comes the infrastructure layer, where companies like Supermicro build the physical systems housing these chips. Above that, platform companies develop tools for AI development. Finally, at the top, application companies like Palantir and C3.ai deliver the actual solutions businesses use. The smartest investors take slices from each layer of this cake. Different parts of this stack grow at different rates depending on where we are in the AI adoption cycle. Building a balanced AI portfolio starts with your personal situation. If you're a recent grad with student loans, you might put 70% in established players with proven business models while directing 20% to growing companies and saving 10% for high-risk, high-reward bets. This approach lets you build wealth steadily while still having excitement in your portfolio. Your time horizon matters too. If you're 25 and investing for retirement, you can handle more volatility with emerging players. But if you're saving for a house down payment in 2 years, stick with stable, cash-generating businesses that won't collapse if the market stumbles. When evaluating AI companies for your portfolio, focus on these critical metrics. Revenue growth rates that outpace the overall market. In the AI world, look for growth above 20% annually. This shows a company is gaining traction faster than competitors. Profit margins that demonstrate the company can actually make money. Healthy gross margins above 50% suggest a company has real pricing power in the market. Cash flow situation, especially important for younger millennials who understand the struggle of making ends meet. Companies should have enough runway to reach profitability before needing more funding. Customer diversity across multiple industries. Just like you wouldn't put all your savings in one bank, companies shouldn't rely on just a few major customers. If picking individual stocks feels as overwhelming as choosing what to watch on Netflix, AI-focused ETFs offer a simpler way to gain broad exposure. These funds spread your risk across dozens of companies instead of betting on just a few, like having a professional DJ mix your playlist instead of creating it yourself. For those wanting a more hands-on approach, build your own mini ETF by selecting 1 or 2 companies from each layer of the AI stack. This is like creating your own custom meal kit instead of ordering takeout. More work, but perfectly tailored to your taste. This balanced approach can win in multiple scenarios, like having both sunscreen and an umbrella when you head to the beach. If Nvidia stays dominant, you win there. If challengers like AMD gain market share, you're covered. And if application companies like Palantir grow faster than expected, you'll benefit from that too. To track your AI investments, watch for these success signals. For chip companies, look for announcements about major cloud providers using their technology. This is like landing a celebrity endorsement. Infrastructure providers should be expanding facilities and manufacturing capacity, similar to a popular restaurant adding more tables to meet demand. Licensing businesses need growing royalty rates and new partnerships, which expand their reach like a social network adding new users. Application companies should show strong customer retention and expanding contracts. Think of it like friends who not only stick around, but bring new friends to your parties. The beauty of diversification is that it reduces your risk while still exposing you to AI's explosive growth. It's like having friends in different social circles. If one group has drama, you've still got others to hang out with. Historical data consistently shows that diversified tech portfolios often deliver better risk-adjusted returns than concentrated bets on market leaders. If you'd put all your money into Microsoft in 2000, you'd have had a rough decade. But if you'd spread investments across emerging areas like e-commerce, Amazon, and search Google, you'd have thrived even as Microsoft struggled. The verdict: which company has the best shot at Nvidia's crown? History teaches us that tech giants can be vulnerable. But let's get real. You're dying to know which company actually stands the best chance against Nvidia. When we look at the cold, hard data on chip performance, market growth rates, and enterprise adoption, one challenger emerges with surprising advantages that most financial media completely overlooks. After analyzing 5 worthy contenders to Nvidia's throne, it's time for the verdict. Which company has the right mix of technology, market position, and financial muscle to potentially outperform Nvidia in the coming years? Tech analysts don't unanimously agree on who's best positioned. Some point to AMD's direct competitive approach, while others favor ARM's licensing model. Each company offers a distinct strategy to challenge Nvidia's dominance. AMD emerges as the most direct competitor targeting Nvidia's core business. Their MI325X accelerator, with its massive 288 GB memory capacity, gives them a genuine technological edge in certain AI workloads. The explosive growth in AMD's data center segment, which more than doubled in the September quarter, demonstrates serious momentum. While Nvidia maintains market share dominance, AMD's projected 98% growth in their data center unit for for 2024 stands in stark contrast to their overall company growth of 13%. This targeted expansion in Nvidia's strongest segments makes AMD the most straightforward challenger. ARM Holdings brings a completely different approach with their licensing model. They profit from virtually every AI device without requiring massive capital investments. Their business model creates exceptional operational leverage, selling the same intellectual property thousands of times with minimal additional costs. Their planned price increases of up to 300% for newest chip design licensing fees could dramatically boost revenue without corresponding cost increases. This pricing power demonstrates remarkable market strength in an industry where margins face constant pressure. Supermicro occupies a unique position in the AI infrastructure space. Rather than competing with chip manufacturers, they build specialized systems that optimize those chips at scale. Their direct liquid cooling technology addresses critical needs as AI workloads become increasingly power-hungry, with CEO Charles Liang revealing that over 30% of new data centers are expected to adopt this approach next year. Supermicro benefits regardless of which chip company dominates. They're essentially the arms dealer in the AI wars, profiting from overall AI infrastructure expansion. On the software side, Palantir Technologies focuses on the application layer. Their $401 million follow-on contract from the U.S. Army for their Vantage platform showcases their government relationships, while they increasingly secure commercial deals. Palantir specializes in solving complex, mission-critical problems that command premium pricing rather than building general AI tools. C3.ai represents the purest play on enterprise AI applications. Their recent quarterly results showed 26% revenue growth to $98.8 million, proving their industry-specific AI solutions are gaining traction. CEO Tom Siebel has highlighted strong momentum in their generative AI offerings. Their specialized approach addresses the gap between general-purpose AI tools and specific enterprise problems. Now for the decisive comparison. When evaluating these contenders based on technological advantage, financial strength, and growth trajectory, distinct patterns emerge. AMD stands out with their direct competitive positioning and impressive data center growth rates. Their technological edge in specific AI workloads and growing cloud provider partnerships demonstrate they're capturing meaningful portions of Nvidia's core business. ARM Holdings offers perhaps the most defensible business model in the entire AI ecosystem. Their licensing approach spans countless devices while requiring minimal capital investment. Few technology companies can match ARM's extraordinary pricing power and operating leverage, creating a uniquely attractive risk profile within the AI sector. Supermicro's specialized systems approach provides essential infrastructure regardless of which chip manufacturer wins the market share battle. Their cooling technology solves critical problems as AI computing demands intensify, positioning them to benefit from overall industry growth rather than needing to outcompete specific rivals. Palantir and C3.ai capture value differently at the application layer. Palantir's focus on mission-critical solutions creates high switching costs and sticky customer relationships, while C3.ai's industry-specific applications address precise business needs that general AI tools can't solve efficiently. Taking all factors into account, AMD appears best positioned for direct competition with Nvidia, given their technological advantages and targeted growth in Nvidia's core markets. However, investors seeking better risk-adjusted potential might prefer ARM Holdings, whose capital-light business model and broad ecosystem exposure provides a more diversified approach to profiting from AI growth. This analysis reinforces our overarching narrative. Diversification remains your strongest strategy in the rapidly evolving AI landscape, as different companies will capture value in different segments of this transformative technology. And that's what makes the AI landscape so exciting right now. As Alex Karp of Palantir noted, AI is going to be crucial in the next generation of warfare. But it's transforming virtually every industry, creating multiple lanes for investment beyond the Nvidia highway. I'm not saying dump your Nvidia stock tomorrow. What I am saying is that diversification across the AI ecosystem makes financial sense. The data confirms this. Diversification in tech investing can cut portfolio volatility by up to 30%, helping you ride out those stomach-dropping market swings. The promising companies we've covered aren't trying to be Nvidia 2.0. They're carving their own paths in infrastructure, chip architecture, and enterprise applications. By building a balanced AI portfolio, you position yourself for success regardless of which specific company wears the crown. Remember, in this AI gold rush, the smartest investors aren't just betting on one miner. They're investing